So I'm going to get started with our webinar tonight on the key to retirement success. My name is Kathy Neely. I'm one of the financial planners with Sensible Money. I'm on the East Coast. Dana, yeah, that's perfect. We have our map here that we'd like to show everyone where we are. I'm in cold Boston, and yes, it has been certainly a winter day today, finally. Dana on Spa is in Scottsdale, Arizona, which is where our main office is, and we have a couple of other financial advisors there as well. We also have a financial advisor on the West Coast, and Jody, who really holds our office together, is up in the Northwest area in Oregon. But what we do is we are able to work with the internet service and everything that we have. We're able to work with clients all over the United States, which is fantastic. So what I'd like to do is to introduce Dana Anspaugh, who's going to be doing our webinar tonight. And she's not only the founder of our firm, Sensible Money, but you may have read her articles or seen her on About.com's Money Over 55. She's been writing for them since 2008, and she's also a contributor to MarketWatch as one of their retire mentors. So with that, Dana, I'm going to turn it over to you, and we can get started with our webinar.
Great. Thanks, Kathy. So I want to start off and just thank everybody for taking the time out of your evening to attend our class. We are going to make it worthwhile. We're going to go through about a 1-hour presentation. During that presentation, you are welcome to type questions into the question box. And what we will do is get to them all at the end. If Kathy does see a question come in that's relevant to one of the slides we're on, she may at times interrupt me and just point that out and make sure we can clarify anything. As if one of you asks, it's entirely possible that there are many others who are wondering the same thing. So please don't hesitate to type questions in. We do want to make sure that we get them answered. And so what I want to do is get started and really talk about why we do planning. This has been one of my favorite all-time slides. I don't think anyone wants to end up like this adorable woman. I've often heard retirement described as a series of irrevocable decisions, and that is one of the challenges. There are many decisions that you make as you're transitioning into retirement that you cannot change later. Even the decision to leave your full-time employment. You know, there are cases where you can go back to work, but oftentimes once you step outside of a career, it's difficult to step back in. And that's what makes it so important. It's really important to do a series of stress testing and take a look at how your plan may hold up over a variety of conditions. We're going to talk about what that looks like tonight. What we like to do is frame retirement into certain things that you cannot control and certain things that you can. All of the things you cannot control are on the right-hand side of your screen. Longevity, how long you live, market returns, what's the market doing right now? Inflation, how fast are prices going up? What's the economy doing? Those are things that people spend a lot of time talking about, and still, those are many of the things we get the majority of questions about, specifically related to the market and the economy. On the left-hand side are things you can control. How much you spend, how you manage taxes, are you tax efficient or are you paying too much, the level of investment risk that you take on, and your potential retirement date. Maybe it makes sense to work longer, or maybe you should retire earlier. So what we want to do tonight is spend the first half of this webinar going through the things on the right-hand side, all of the things you cannot control, and taking a close look at them. And then I want to shift over to the things on the left-hand side, the things you can control, and talk about how we can use those things to manage the things that we can't control on the right. So we're going to go in order, and we're going to start by taking a look at longevity. This is what the mortality tables tell us about how long we might live. What you're looking at here in the darker gray dotted line is the life expectancy probability of a male who is age 62 today. And then the dashed gray line is a female age 62 today. And then this darker black line is the probability for a couple that either of them might still be here at a particular age. So I want to focus for a second on age 90. And you can see here for a single male, the probability that a single male might still be with us at 90 is less than 20%. The odds go up significantly for a female. If you're married and planning as a couple, take a look at the probability that either of you would still be here at 90. It's pretty high. And yet I can't tell you how often people come into the office and go through our planning process and say, what, 85, 90? I won't be here. And of course, my response is, but what if you are? Our job is to look out for the 80-year-old you, the 85-year-old you, the 90-year-old you. I went to lunch last week with a client of mine who now lives in an assisted living home, and he's 89 years old. And the place he was at was just beautiful. His quality of life is outstanding. But I can assure you, when he was younger, he didn't think that would be him. And longevity can surprise us. This is my grandpa. Both my parents were divorced when I was 3, and both remarried by the time I was 8. So I had a lot of grandparents. Grandpa Getters, who you're looking at here, was my mom's dad, and this was a family reunion for his 90th birthday. Now, Grandpa has since passed, but at the time we all attended this family reunion, Grandpa had been a single survivor for many, many years. Grandma had passed from breast cancer many years earlier. Now, if I were to look at the longevity tables that we just looked at, this wouldn't have shown up in the odds. And so there are certain planning decisions that you can make that hedge against a long life. And we don't think of that as something you need to hedge against, but the reality is you want to make sure that if that's you, that your quality of life is solid and that you have enough assets to provide all the medical care you need and all your living expenses and to maintain a quality life. And many people tend to look at certain things only as an investment decision. They forget about these other risks, what we call longevity risk, and how certain planning decisions can help protect you against that risk. For example, one decision that helps hedge longevity is the decision about how you begin pension plans. So this analysis that you're looking at here was for a single woman. We were looking at either taking a lump sum option on her pension plan. Her company was offering her $341,000, or she could get a life annuity for $28,322 a year. What you're looking at here is a projection that says, well, if she took the lump sum and it averaged 4% a year, 5% a year, 6% a year, or 7% a year, and she invested it and withdrew the same amount that the annuity was going to provide her, how long would the money last? And so what you're seeing here is that if her lump sum only averaged 4% a year, the funds lasted from her age 55 to 70, and then she was out. She would be wishing she had taken the annuity. If her funds could be assured of earning 5% a year, they lasted until her 72, and at 6% a year until her age 75. And she had to be assured that her investments could average 7% a year or higher after all fees in order to have the funds last to her age 76. And we'll take a look later on in this presentation about the likelihood of achieving these different rates of return. But in her case, what this annuity option did was hedge longevity. She could easily live to 90, 95, and in the traditional investment platform, she would be out of money, but the annuity is going to provide her income for life. An annuity here was not a product that she bought. It was the annuity option offered through her pension plan. Another decision that works in a similar way is the decision as to when to take Social Security. So I recently released a book called Social Security Sense, and it walks through all of the claiming options. In particular, Social Security rules changed and new laws came out this past November. So if you or anyone you know are turning 66 this year, you need to pay close attention to your options. There are certain strategies called a file and suspend that those who reach 66 after this year will no longer be able to use, and those who reach age 66 later in this year may not be able to use. If you have a prior marriage that was over 10 years in length and you're single now, if you reach age 66 by the 2nd of this year, by January 2nd of 2016, you've already turned 62, 62, then you can still file a restricted application for spousal benefits. Now, you may not know what that means because we haven't gone through all of the analysis, but what you need to know is that the way you make these Social Security decisions can serve as, again, a powerful longevity hedge, protecting you later in life. And if there are no special rules that apply to you, you go, you know what? I'm only 61 right now. I don't meet any of these other requirements you were talking about. Then if you're married, it still makes sense for the higher earner of the two of you to delay to maximize survivor benefits. So if you think about the two of you and you look at what someone could get at age 70, whichever one of you would get the most at age 70, you want that person to delay until that claiming age because that dollar amount now becomes a survivor benefit for whichever of you would be the longest to live. Now, people often run Social Security through a calculator and some kind of rate of return analysis, and we love the calculators and we love the rate of return analysis, but you need to also look at this as a unique way to hedge against a risk that you face in retirement, and that's longevity risk.
Dana?
Yes.
Just want to interrupt you for a quick second. Can you just touch upon the Social Security changes that have taken place over the last couple of months?
Yeah. So there are certain rules that were in place that particularly applied to married couples and to people who had a prior marriage that was at least 10 years in length. And I'm going to start with a married couple. It's the easiest way to explain. Basically, the higher earning spouse, you could take a couple and at 66, one spouse could do something called a file and suspend. So they were filing for their benefits, but immediately suspending those benefits so they wouldn't actually receive them. What that allowed was that their spouse could collect what's called a spousal benefit. And in order to do that, the spouse had to file something called a restricted application. So they wouldn't be applying for their own benefit, only for the spousal. And if the age differential was just right, the spouse would collect that spousal benefit for 4 years and then switch over and get their own full retirement benefit. And the initial spouse who suspended at age 70 would turn on their own retirement benefit. And by coordinating, a couple could get the maximum amount was almost it was a little over $60,000 more than if they hadn't used that particular strategy. So what the new rules say is that if you reach age 66, full retirement age, by May 1st of this year, then you are still allowed to do what's called this file and suspend to allow your spouse to file a restricted application. And as far as the spouse who is going to file the restricted application, they had to have reached the age of 62 by January 2nd of this year in order to use that feature. Those who reach 62 after January 2nd of this year will not be able to file a restricted application. It's off the table. Those who reach age 66 after May 1st of this year will not be able to use the file and suspend for this particular purpose. Now, there's one caveat. There's one Social Security attorney who believes that those who reach age 66 up until September 1st of this year can actually use the strategy. I know I have one client that falls in that window and fits this description, so we will be finding out later this year how Social Security interprets those rules. But if you know anyone turning 66 between May 1st and September 1st, there are definitely some things they're going to want to do to try to preserve their file and suspend option if it's of benefit to them. Did that help, Kathy, or did that just make it more complicated?
No, that's perfect. We just had a couple of questions about the changes. So, no, that was great. Thank you. I didn't want to get you too in-depth with that question, but I think you did a great job, just the overview.
All right, thanks. So another thing on the right hand of that drawing we were looking at as far as things you can and can't control, the second thing was market returns. Now, we've been getting a lot of questions about market returns lately, and what I want to do is take a look at what market returns have been historically. So what you're looking at here on the screen is what I sometimes refer to as the most misleading graph used in the financial services industry. At the very top, you see this line labeled small cap index, and this is showing you that if you invested $1 in 1926, your dollar would have grown to over $18,000 if you invested it in small cap U.S. stocks. In large cap stocks, it would have grown to just over 5,000. And then you can see the results in long-term government bonds, treasury bills, and then inflation. It takes $13 to buy at the end of 2014 what you could buy for $1 back in 1926. So I'm going to ask all of you to just type an answer into the chat bar. What looks great on this graph? There's no right or wrong answer. Just type in what comes to your mind. When you look at this graph, what looks great? Seeing a lot of answers come in. I love the obvious ones. Yes, I'm getting a lot of small cap, small cap, small cap. Believe it or not everyone answers that way. But overwhelmingly, those are the answers that are coming in. And I would agree, yeah, small cap looks great. Stocks as a whole look great on this graph. Sure, if you've got 80 plus years. So what I want to do is take a minute and zoom in and look at some of the underlying decades that appear in this time period. First, let's take a look at 1969 to 1978. Here, you see this orange line down here with small cap stocks. At one point, your small cap stocks were worth about 50 cents on the dollar. If you were able to hold on and maintain your portfolio, I saw one answer come in, a balanced portfolio, I love it. And that portion of your portfolio, if you just held on to it, would have recovered, but it would have been pretty scary during that time period. As a matter of fact, during that decade, inflation outpaced everything else, averaging over 6.5% a year. It didn't really matter what you invested in, you lost purchasing power. Then let's move on and take a look at the decade of tech stocks. I still think a lot of people are going through post-traumatic stress disorder after recovering from this. This was the time where no one had to worry about retirement. All you had to do was just invest a little bit and your money was going to earn 12, 14% annualized returns. Didn't work out that way. But during this decade, the S&P large cap stocks averaged 19% a year. Small cap 15%, inflation stayed tame, and even government bonds did quite well, averaging over 9% a year. Then we move into what some in the media have deemed the lost decade. And this was the period of time from 2000 to 2010. And here you see S&P stayed flat, averaging 1% a year. Small cap did well, government bonds did well, and inflation stayed tame. And this is the time period where I see someone had typed in the answer, a balanced portfolio. You are right. Over this particular decade, a balanced portfolio fared just fine. The decade wasn't lost at all. But simply because the S&P stayed flat, the media deemed it the lost decade. And that's often, a problem we encounter in trying to answer questions from people is the media focuses on the S&P, which is 500 stocks. In reality, if you have a global portfolio, particularly a portfolio composed of index funds that has exposure to all of the publicly traded stocks in the world, then you have exposure to over 15,000 stocks across the world. And yet in the US, the media tends to focus on just the S&P as if that was the market. Or even worse, the Dow Jones, which is only 30 stocks. Now, in the middle of this decade, you see 2008 and 2009 over here. And those of us in the business often describe that particular 18 months as being in the fetal position. We worked so hard to try to keep our clients invested, to stick with their plan and stick with their portfolio, but it was really challenging. I want to show you why we worked so hard. This is an actual client that I've worked with since December of 2004. They just recently retired, but this is tracking the orange line that you're seeing is their net amount of money invested, and the blue line is their portfolio value. So when they're in accumulation mode, obviously they're adding funds to their portfolio over time. And so you see this orange line going up, up, up each year as they're contributing money. Now, this was 2008 and early 2009 right here. So yes, there was a point in time where their portfolio was worth less than the total amount of their contributions. But they stuck with their plan. Matter of fact, they just plugged right along and did what we said. And here they are today. And you can see this orange line is starting to go down a little bit at this tail end. And that's because now they're retired and they're withdrawing money, but their portfolios were substantially more than what they contributed. And when you look back on it, this was just a blip. It really didn't affect their long-term plan. It didn't affect the projections we'd made for them. It had no effect at all. And that's why we work so hard to get people to look at things as far as the long-term view and the big picture. And as you near retirement, the other thing you have to be aware of is the difference between what we call investing for accumulation and investing for decumulation. So this slide provides a good example. If you're in the accumulation mode and you have a lump sum to invest, this is the actual S&P from 1973 to 1982, and it's $100,000. And the average, if we used what's called an average annualized return of the S&P for that decade was 6.7%. So if we were to plug this into an online retirement calculator, here's what you would picture. You would picture your 100,000 growing like this, and you would finish the decade with 191. And over here on the right, you see the actual calendar year returns. In reality, due to market volatility, here's what happened to your 100,000. At one point, it was worth 62,000, but if you maintained your portfolio and didn't change anything, it recovered, and at the end of the 10 years, that volatility didn't affect you at all. Now, it's a different story once you transition into retirement and you're taking money out. This is the exact same time period, same 100,000, same average return of 6.7%, but now we're withdrawing $6,000 a year each and every year. And here's the end of the year balance after taking that withdrawal and applying the market return. And so what we see here is if I plugged this number into an online calculator and said, well, you're going to earn 6.7% a year, no problem. The calculator would say, well, at the end of 10 years, even after taking out $6,000 a year, you have $109,000 left. But because of the market volatility, you only have $83,000 left. During the down years, that $6,000 that you took out, you had to sell more shares. And so when the market recovered, you didn't have as much there participating in that recovery. Now, there are ways to invest that can help minimize the effects of this. There's no way to completely eliminate the effects of what we call sequence risk, that you should retire into a bad decade. We can't tell you what your first decade of retirement is going to look like, but there are certain ways that you can invest that can help protect your retirement funds so that if you get one of those worst decades, your plan still stays intact. And this is a sample of a client that has been our client since 2006, and she is retired. And so here you see her orange line is gradually going down. That means she's withdrawing funds. Now over here you see the spike, and I'll explain that in a minute. Obviously there was a large contribution to her account. She is a widow, and she became our client in 2006, and then of course this time period you're seeing right here again was 2008 and early 2009. Despite that, she stuck with the plan and continued the withdrawal pattern that we'd laid out for her. And well into 2013, she had almost the same amount she'd started with, about $1 million. Now, that is how a decumulation plan should look. Despite this market event, it shouldn't disrupt the long-term plans, your ability to withdraw what you need if the planning was done correctly on the front end. Now, I want to digress for a minute and tell you a little bit about this spike. This woman is a widow, and her husband, she was not very financially savvy, and he passed rather suddenly and hadn't left her with a team of advisors. And so a, quote, family friend came in and offered to buy their art collection. And so her husband had been in the art world and had a substantial collection, which she sold to this family friend. And she sold it on an installment payment structure, and he made a few payments and then stopped paying. He owed her millions of dollars. And so through my continuous prompting, eventually we got an attorney and she litigated, and although she didn't get nearly what the collection was still worth, this large inflow right here was when the case finally settled and she did get a substantial settlement payment. Now, I share that story only because it's so important to understand as a couple which of you may be more financially savvy and how to give the less financial savvy spouse the team that they may need to navigate through some of these decisions. There are certainly people out there who may call themselves friends, and this was one of those situations, when in fact they were an opportunist. And I have seen many cases of that, unfortunately, over my 20 plus years of practice. Moving on, one of the other items on the right-hand side of what we can and can't control, on the side of what we cannot control, was inflation. Now here you see what a quart of milk cost in 1913. In 1963, it would have bought you a small glass, and in 2013, 9 cents would have bought you 6 tablespoons of milk. When we talk about inflation, that's really what it is. It's erosion of purchasing power. So your dollar, if it doesn't keep pace with inflation, or your 9 cents in this case, won't buy the same amount or the same quantity of goods and services. Now, a lot of retirement planners make a big deal about inflation and its effect on you in retirement. In reality, it affects different sectors of the population differently. And I'm going to explain this graph in a few ways. What you're looking at here is somebody age 65, actually 3 different people. One retiree spends, the green line, about $25,000 a year. The blue line represents a retiree who spends about $50,000 a year. And the red line represents a retiree who spends about $100,000 a year. Now, if each of these retirees truly needed their purchasing power, their amount that they spend each and every year to keep pace with inflation, what you would see here is a flat line. So this dollar represents a dollar in what's called real consumption, meaning out here, if it was still $1, it would buy the same amount of goods and services at age 95 that that dollar would buy at 65. What this declining line means is when they study real retiree behavior, they have found that even those with means, they don't increase their spending with inflation. As a matter of fact, in inflation-adjusted terms, this downward curve means their spending declines. Now, it doesn't truly decline in terms of the actual dollars spent, and I'm going to explain that in a different way. So here's what I mean when I say that in inflation-adjusted terms, their spending declines. This projection, each column represents a calendar year, and everything below the flat line is an outgoing item. So this orange color represents what we call grouped living expenses, and this yellow color represents estimated outgoing taxes. So here, this orange bar at the beginning of this projection was $80,000. Now you see this black line highlighted in 2030, and at a 3% inflation rate, that 80,000 grew to 124. And so when I say some retirees don't need their income to increase at that rate, what I mean is in a typical projection, we would say, all right, well, your spending needs to go up at 3% a year. And we like to project that way to be safe. But in reality, what we're seeing is that at a 2% increase in spending, that $80,000 in 2015, the actual dollar amount that went out in nominal terms still went up. It went up to 107. But it didn't have to go up at the pace that inflation was tracked at. And that is actually now becoming a well-documented phenomenon in retirement. Now, for those that are low spenders in retirement, and typically that means, $25,000 a year, maybe $50,000 a year of total outgoing spending, those people are more affected by inflation, and that makes common sense. Increases in energy prices, medical costs, food, just the basic necessities are going to take a big bite out of their budget. Whereas those that have more to spend also have more discretionary spending, and often some of those extras, they just tend to naturally spend less as they get older. The key here is to customize the assumptions that you use when you're doing your planning so that it actually makes sense based on what we see real retirees do. Another item on the right-hand side of the drawing, the items we cannot control, was the economy. So I'm going to ask you guys to type something in. We're going to talk a little bit about what's in the news. Now, outside of the Arizona Cardinals, I want to ask you what's in the news. Not normally a big...
Wait a minute. I'm the Patriots fan over here.
Oh.
So we need a Patriots helmet there too.
Sorry, Kathy, I was focused.
Go ahead.
Not normally a big football watcher, but with the Cardinals almost in the Super Bowl this year, I've been paying a little more attention. So I'm seeing some answers come in. What's in the news right now? What is particularly when we talk about the economy and markets, what are you hearing about? I'm seeing a lot of China. Yep, China. The elections. Yep. Oil, I'm seeing come in. Iran. Fantastic. Issues with Chinese economy, effects on U.S. markets. Income inequality. Oh, I like that one. Yes, market volatility. All of those are correct. The two that came to my mind as I was preparing was, first of all, the answer that I heard and saw a lot of you type in first was China. It seems that every time I'm looking on the internet or watching the TV right now, everybody's talking about the Chinese economy. And the second thing I've heard the most about lately is the price of oil. As a matter of fact, with the markets reopening today after being closed yesterday due to the holiday, reading the news this morning, that's what I was reading was, oh, the Chinese economy didn't slow down as much as people thought, and all of a sudden, it seemed like the commentators were saying everything's fine. Last week, of course, the sky was falling. So we tend to get so focused on these things that are in the news, but I want you to step back and think about what effect do they really have. So think back just a few years ago, 3 years now. It's 2013, and there were two things that were in the news, and even at really 2012 and 2013, and people thought about going to cash. They thought that, their portfolio wasn't safe anywhere. So again, just what do you remember? 2012, 2013, what were some really big things that were in the news that people were freaked out about during those years? All right, I'm seeing some answers come in, and I got to get down to that. All right, go ahead. I'm going to wait a few more minutes. Type in, not a few more minutes, a few more seconds. Type in answers. What were people talking about 2012, 2013? The budget, the economy, underwater housing, those are all great answers. So the main things, the price of gasoline, the sequester, the main things that were in the news in those years, if I can get there, one, Greece. People were really worried about what was going to happen in Greece. And the other was the potential for the government shutdown. Actually, the government did shut down for a bit in 2013. So it's funny how a few years later it can be difficult to remember, and yet at the time the media focuses on these events, and if you listen to them, you can give these types of events an overblown place in how they're actually going to affect your future. As we saw with some of the graphs of real clients, these events should have no effect on your future if you've developed a solid long-term plan. And as far as listening to some of the commentators that give investment advice, this, for example, was Money Magazine in August of 1997. And the headline, "Don't just sit there, sell stock now." Of course, we saw from our decade of tech stocks, the next 2 years in the stock market were fantastic. But in 97, they told you to sell stock now. And then in 99, right before the crash, it was tech stocks. Everyone's getting rich. Here's how to get your share. You have to understand that the media's focus is typically about creating sensation and getting your attention and creating emotion Emotion's going to get you to buy whatever it is that they're selling. And so it's not necessarily focused on long-term advice that's going to help move you toward your goals. The right kind of long-term advice is really boring. And I love Warren Buffett's quote at the bottom here. Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. So we've moved our way through the items on the right-hand side of the drawing. I want to shift now to the items on the left-hand side of the drawing and talk about how you can use those items to manage around these things that we cannot control. Let's start with spending. While you're in the accumulation mode, if you have more dollars coming in than going out, that equates with success. Obviously, more going out than coming in, and you've got failure. Now, understand this doesn't necessarily apply once you're retired. Matter of fact, many people tell me, I want a plan where I die with $1 in the bank. Now, if we go back to longevity, if you can tell me when you're going to go, I can create that plan. But unfortunately, life doesn't work that way. But you can have a planned spend down of principal and a set of rules and adjustments that you make to make sure that you never run out. And yet you can say, well, look, I've worked so hard to save this capital. I do actually want to spend some of it. And so in that case, in retirement, there can be cases where there is more going out than coming in, and it works just fine. But the actual biggest failure that can occur in retirement planning is to not accurately estimate the amount that needs to go out to maintain your lifestyle. And there are certain areas that we routinely see that are not estimated correctly. One is healthcare. This calculator was run off a website called HVS Financial. And what we did was take a look at a 60-year-old female today with no medical issues. And when she turns 65 in 2021, her annual out-of-pocket costs are going to range from about $6,800 to $13,000 a year. Now, this is in future inflated dollars, so these dollars have already been adjusted upwards with inflation. You can see here the underlying composition. A large portion of her premiums would be going toward Medicare Part B premiums. We'll take a look at how those work on the next slide. Likely she's going to have a Medicare supplement policy. She's going to have dental, and then OOP stands for out-of-pocket costs. And obviously we want you to have a healthy retirement. And we think that what you need to do is plan for this kind of out-of-pocket expense. And then in the years where that doesn't occur, that just becomes a surplus in your plan. But many people think, wow, I'm going to go on Medicare at 65 and my health care is going to be covered, when in fact Medicare will only cover about 50% of your outgoing expenses. And this is the out-of-pocket cost you can be looking at to cover the other 50. As far as Medicare Part B premiums go, many people don't realize that they are actually means tested. That means the higher your adjusted gross income, the more you're going to pay. The way it works is the year you turn 65, they take your adjusted gross income from your tax return 2 years prior. And every year they look at your adjusted gross income from your tax return 2 years prior. So if your adjusted gross income as a single is less than $85,000, you'll pay the baseline Medicare Part B premium of $121 a month. And for married, if your adjusted gross income is less than $170, you'll pay that baseline premium of $121. But as you get into higher adjusted gross income amounts, for those high-income retirees, you can be paying as much as $389 a piece if you're married. That's a significant difference. When we start adding in thousands of extra outgoing dollars to a plan, that can make a difference in how long the money lasts. And people forget to build these costs into their projections. Another cost we see missing a lot is home upkeep. This is my living room, and this is my baby girl down here. Her name is Honda. And last year in 2015, I had to replace my refrigerator. Several of my valves went out on my watering system. I had other plumbing repairs. In total, it was about $4,000 of outgoing expenses, just routine maintenance, not anything major, even like a new roof, not even new flooring. And we often see that people forget to build routine home maintenance. One thing you can do is take the structural value of your property, usually that's shown on your property tax statement, and take 3% of that. That can often be a good proxy for what you would need to plan on building into your budget for home maintenance. And you can create a sinking fund. For example, if you had built in about $3,000 a year of repairs and some years you don't need it, you let that accumulate in a side savings account so that in the years where a big expense item comes up, you've slowly been saving for it. When we look at spending in retirement, another thing you can do is break your spending into phases. There's a book that breaks it out into what they refer to as the go-go phase, the slow-go phase, and the no-go phase. So go-go is younger. You're younger in retirement. You're still traveling. You certainly don't see yourself as old. Slow-go typically is brought on around the age of 70 to 84. You're slowing down, you're not going out as much, and this is often where we see that spending decline. During the slow-go years, people tend to spend 20 to 30% less than what they spent in the go-go years. And then you have what can be referred to as the no-go years, where health issues come about and spending may creep back up, but now it's on health-related items rather than travel. When you project out a timeline of your living expenses, you can build these types of things in. We often build extra spending on travel and vacations during the first 10 years of someone's retirement to account for this. Taxes are another outgoing item. Retirees significantly underestimate the impact taxes are going to have. And interestingly enough, in this survey that's referenced here, some retirees found that their top expenses included taxes rather than health care. One of the rules of thumb I find that can cause people to I don't know what the word is, underestimate, I guess is the word, what they might spend on taxes is the 4% rule. So you'll often see these rules of thumb floating around on the internet, and one of them says, you can withdraw 4% of your portfolio. So if you have 100,000, you can withdraw 4,000 a year. Well, that doesn't account for taxes. There's a big difference. If that 100,000 is inside an IRA or 401k, every dollar that comes out is going to be subject to income taxes. Depending on your income, you might only keep, 60 cents on the dollar. You might be lucky and keep 75 cents on the dollar, but for every 4,000 you withdraw, there won't be 4,000 to actually spend. Now, if that same 100,000 was not inside a retirement account, it might look entirely different. Depending on your tax situation, perhaps the entire 4,000 would be available to spend. And so by not accurately accounting for what the tax impact is as you withdraw in retirement, people can significantly underestimate the cash flow that's going to be available to them. This is the way the tax brackets are actually structured right now. These are 2016 rates that we're looking at. So if we look at a married couple, what you're seeing here is that for every dollar over $18,550 of taxable income, these numbers are taxable income, meaning after you've been able to take your standard or itemized deductions and after you've been able to apply your personal exemptions. So you have taxable income here. First 18,000 taxed at 10%. For every dollar that falls in this range, it's taxed at 15. And here's where the big jump occurs. For every dollar that falls over 75,300, now your tax rate jumped up to 25%. Now sometimes there's planning that can be done, so you can withdraw money from IRA accounts during these years rather than wait so that it's all taxed later at a higher rate. The other thing you'll notice over here is this column. QD stands for qualified dividends and then long-term capital gains tax rate. So if you have funds that are not tucked inside an IRA, then depending on how you manage that portfolio, there can be years where you can realize capital gains and pay zero tax on the gain. There aren't too many ways where you can get tax-free money. A lot of what we end up doing for our clients is managing this process so that we can at least get them the most after-tax income possible. And that's by using a tax projection to know what years they may fall into the 0% rate. Planning for taxes is important. It's even more important than ever during the distribution phase. And I see somebody typed in, please explain how Social Security benefits are taxed. That is actually the next slide. I'm not going to go into all the details, but basically there's a formula, and that formula takes something called your combined income. So income that you have that is not Social Security. And then if that income, let's take a married filer, exceeds certain threshold amounts, then a portion of your Social Security becomes subject to taxation. And so what happens is first you calculate your combined income, and then 3 tests are applied. And here's the 3 tests below. So first, you could pay tax on 85% of your Social Security benefits, or test number 2, 50% of your Social Security benefits plus 85% of the amount of combined income that was over this, actually in this case, the second threshold amount. Or then there's this third test. You could pay taxes on 50% of your combined income that's over the first threshold amount plus 35% that's over the second threshold amount. All right, you got that? I'm going to quiz you all on it. Actually, this formula is part of any 1040 tax form. You can download it off the IRS website. But the reality is what can happen in retirement is you can take money out of an IRA and it can then fall into this formula here. It's considered part of your combined income that you have that's not Social Security, and it can then make more of your Social Security benefits subject to taxation. And again, for some people, there are ways to do some planning so that you withdraw from retirement accounts early on before Social Security starts, and you can lower your overall tax liability in retirement. And I see somebody asking for an example. We're not going to go into an example. It's beyond the complexity of what we'll be able to get into in this webinar. The other thing that plays into all of this is the required minimum distributions. So for those of you that have IRA, 401k, 403b accounts, 457 accounts, most tax-deferred retirement accounts, when you reach the age of 70 and a half, you must start taking money out. And conventional wisdom says you don't take any money out until you have to. So a lot of people let those funds accumulate. And here's what happens. At age 70, you take your December 31st balance from the prior year and you divide it by this divisor. Actually, this is during the year you would turn 70 and a half. And for every 100,000 that you had at year end, you would be required to take out $3,650. Now, I projected out how that divisor changes, and then here I jumped up to age 84 just to show you that as you get older, you have to take out more and more. And so at 84, you have to withdraw almost, not quite, but getting close to twice the amount that you had to take out at 70. Now what happens is we just looked at that Social Security formula. As you get older, you end up having more and more what's called combined income, your other income sources outside of Social Security. And so later in life, particularly if you're a couple, you're used to filing at married tax filing rates, and now suddenly there's a sole surviving spouse. They find that they are suddenly forced into a higher tax bracket, and more of their Social Security income is subject to taxations because now, later in life, they have more and more combined income. Now, again, for some people, there are ways to plan for that and take more out of the IRA earlier. Matter of fact, a strategy that works for many is taking planned IRA withdrawals between the age of 60 and 70 and delaying the start of Social Security. And that can often make for a nice tax-efficient outcome. Accounting for taxes is probably the hardest part of what we do. There are different layers of tax efficiency. There's simply owning a mutual fund in a non-retirement account that works to minimize capital gains distributions. That would be the simplest layer of tax efficiency. Then there's something called locating assets. Should I locate stocks inside my 401k and bonds outside, or should it be vice versa? And there are certain ways to locate assets that can deliver a more tax-efficient outcome. For example, in many plans, we're not going to touch the Roth IRA until much later in life. So likely we want to place or locate the assets with the highest potential for return and the assets that are least tax efficient inside those Roth accounts. There are strategies where you can harvest capital gains and losses to take advantage of that 0% capital gains rate for low-income folks, or to intentionally harvest losses for high-income folks so they can use that capital loss on their tax return. When you're in accumulation mode, you want to fund retirement accounts based on your tax bracket. I'll give you an example of that. There's a real estate agent I worked with her for over 10 years, and some years her income's really high, and other years it's not. And so we change her funding strategy. During high income years, we have her contribute to what's called an individual 401k plan, and she can take the deduction. And during income years that are really low, we have her fund a Roth IRA. Now we do that because it doesn't make any sense for her to fund a Roth IRA in a really high tax bracket year, and it doesn't make any sense for her to fund a deductible 401k in a really low tax bracket year. Matter of fact, she would do that and then later withdraw it in retirement and end up paying taxes at a higher rate. Now, it's great to save money, so I always encourage people to save, but it also makes sense to use these accounts in a tax-efficient way. And it works the opposite as you start withdrawing in retirement. You want to withdraw tax efficiently, and you can use your tax brackets to determine what that looks like. And then when we get into the sixth layer of what I call my layer cake of tax efficiency, you can do all of the above based on a general set of assumptions, meaning, oh, I think my tax rate's going to be about 33%. Or you can project out an actual 1040 as if your tax return was occurring each year now through life expectancy and say, all right, here's a more accurate way of projecting what this might look like and developing a plan based on my actual tax rates. For those who are in high adjusted gross income levels, have high adjusted gross income levels, there are other things they want to look out for. There's something called phase outs. So if your MAGI stands for modified adjusted gross income is greater than certain limits, and I think these are 2015 limits, so I have not yet updated these, you're going to lose some of your exemptions and itemized deductions. There's something called a surtax. So if your income is over $250,000 for marriage, you're going to pay an extra amount of payroll tax, and you're going to pay something called a net investment income tax of additional 3.8. We looked at how the Part B premiums work. And one thing that high bracket folks may want to focus on is what we call the strategic use of debt. So a big push is to be debt-free in retirement, and I'm definitely a fan of that. But for those who are likely to remain in a high tax bracket throughout life expectancy, the strategic use of debt, home loans and pledged asset lines can actually work quite well and be in their favor. And there's a book I read on this called The Value of Debt, and it's great. It talks about for high net worth folks how debt doesn't necessarily need to be a four-letter word.
Dana?
Yes.
On that last one, I just want to have someone just write in, and I just agree that Medicare Part B, we talked about the Part B being means adjusted, and there is special circumstances that you can get your monthly adjustment lowered if you file for it. So if there's a life-changing event that happens, say you sold your home or something, and it will increase you, you can file to get that adjusted. So it's something to look at, but something to also remember that you can get it adjusted.
You can. I have yet to see someone do it successfully.
Yeah. Yes, exactly. Rules are one thing, but reality is another.
Yeah, so it's one of those cases of reading the fine print.
Yeah.
But thanks, that's a good point. So when we look at low brackets, people who are not going to be in a high tax bracket in retirement, strategies that you can use, one, pay attention to what we call the 0% capital gains bracket. You definitely want to realize gains in years where you will pay no tax. And sometimes just rearranging your portfolio in one calendar year versus another can make a big difference in the amount of tax that you pay. You can fill up your lower brackets. So if you project out that your required minimum distributions later are going to cause you to have a lot more taxable income, you might consider taking distributions earlier. You can use Roths. One of the great things about Roth IRAs is that when you withdraw the money in retirement, they are not part of that formula that determines how much of your Social Security is taxable. As a matter of fact, I've called Roth IRAs and then health savings accounts the two superheroes of retirement accounts. I think they're absolutely fantastic, and they would be the first two accounts that typically you would want to fund if you're eligible. Lower bracket people should focus on debt reduction. It actually makes sense to, if possible, enter retirement with no mortgage and no debt. And you may also be able to qualify for health care tax credits. So if you're going to retire before age 65, there are ways to arrange your portfolio withdrawals so that you would be eligible for a subsidy up until the point that you reached age 65. So moving on, when we talk about tax management and spending, I think I actually saw this question come in the question queue. Somebody asked how much they should plan on spending. If we combine taxes and spending, you'll read on the online articles quite a bit that a rule of thumb says your replacement rate is 70 to 80%. Well, this is a quote from David Blanchett. He's a friend of mine and the head of retirement research at Morningstar. And here he says that although a rule of thumb replacement rate of 70 to 80% is clearly reasonable, it isn't ideal. And moreover, it is clear that the replacement rate is sensitive to the proportion of pre-tax expenses to post-tax expenses. And when you add all of that in, the range expands to 54 to 87%. It's really difficult to use a rule of thumb. You could say, well, I need 80%, and what if in fact you really only needed 54? You could say, well, I need 70% of my pre-retirement income, but what if in fact to maintain your lifestyle you need 87? The reason it's difficult to use a rule of thumb is some people are fully funding retirement plans right now and others aren't. Some people are funding Roth IRAs and others aren't. The expenses that you have right now, some have children and are still paying for college and others don't. And so trying to use a rule of thumb is difficult. We prefer to actually create a budget that says, here's what you're spending right now, factor in inflation, factor in things that are going to change in a timeline format. So we know Medicare Part B premiums are going to start at 65. We know certain other out-of-pocket medical costs are going to kick in when your employer coverage ends. We know we might build in what we call the go-go spending, travel in the first 10 years of retirement. So you can create a timeline so that the spending isn't level every year. It actually adjusts, which is, hey, like real life. I don't know about you, but most spending adjusts from year to year. There's some years where you're able to add more to savings and some years where you need to use savings, and it's not going to be all that different in retirement. You can create a timeline that helps project that out. A customized timeline is definitely going to be better than a rule of thumb. Then as we move into the left side of the drawing where we talk about investment risk, you can manage investment risk. We talked about the different decades. You can't control the results, but you can control the amount of risk you take, and you can look historically and go, okay, here's all the possible results, and if I had invested this way, even if I got the worst historical result, my plan still would work. When that's the case, you are able to transition into retirement with ease. It helps take the stress off, and trust me, it's something that everyone I have worked with is nervous about. That transition from saving money to one day someone telling you have to withdraw some of that savings to support your lifestyle is a scary one. And your investment plan, you want to know that it works no matter what market conditions come around. Now, most people want to start off and they want to ask, what asset allocation should I have? Should I have bonds or bond funds, cash? How much in international, large cap, small cap? And this is the focus of traditional investment planning. As a matter of fact, while you're in the accumulation mode, this is something called the efficient frontier. And typically you'll hear advisors say, all right, well, if you have a portfolio that's 50% stocks and 50% bonds, we have X amount of expected return on the vertical axis per unit of risk. And risk in this framework is measured by something called standard deviation. Standard deviation is typically, if you think of what we call volatility. In one given year, the portfolio could be up 30% or down 30%. That would be a volatile portfolio. And so this traditional way of constructing portfolios is measured on this risk-return framework. And you come out and you say, all right, well, if you allocate more to stocks, you're going to have more volatility, but you also have the potential for higher returns. Well, it doesn't have to work this way, and as a matter of fact, we don't think this is the right way to invest once you are retired and as you are leading up to that 5 or 10 years to retirement. You want to start shifting your focus, because at that point it's no longer about accumulating. It's no longer about how do you achieve the highest rate of return per unit of risk. And let's take a look at that in a different framework. Particularly, let's take a look at risk. So when I say volatility, it's the difference between a peak and a trough. So just type in which of these lines is more volatile, the yellow or the blue? Or maybe some of you might call that purple. Go ahead, type in an answer. Which portfolio is more volatile? Fantastic. Seeing a lot of yellows come in. Seeing a few blues come in. Majority, I'm seeing yellow, a few blues. Actually, so yellow is considered the more volatile portfolio. So if I were to go back to our risk framework, what we call standard deviation, risk is measured by peak to trough. So the difference between a peak and a trough, right? So this is far more volatile than the difference between this peak and this trough. Now I can see why some of you, if you were looking at volatility over the long haul, right, then you would say, wait a second, this one's more volatile. But the standard way of constructing portfolios isn't looking at this. It's looking at this. It's saying we're going to measure volatility over a 1-year time frame. And a portfolio that could have a larger peak to trough in a single year is considered a more risky or a more volatile portfolio. So with the standard framework for building portfolios, in retirement, this portfolio would be considered better than this one. Now let me ask you, if we were to look at this dotted white line here, and we're going to call this actually what it is what's called a critical path. And this was the asset path that would lead you to die with $1 in the bank, right? So if you were ahead of path, if you had more assets than what your projection said, you're in the green. And if you're in the red, that means you're behind path. Which portfolio would you rather have if you were retiring today? Go ahead, this is another one. Which portfolio would you rather have if you're retiring today? Yellow, yellow, yellow. I see one blue. Yellow, yellow, yellow. I see some greens. I get it. Yes, you want one in the green. Absolutely. So most people would want a portfolio that stayed up here. If you're in the red, it means you're at risk of running out of money before your time is up. Whereas up here, you have a large cushion. And in fact, you can take I love this answer, blue if I started with 10 million. It's great. Yes, so then you would be starting way, way up here, and assuming you only withdrew the minimum, your portfolio could lose money for your entire life and you'd still have plenty. That's the ideal situation to be in. So when you test actual withdrawal patterns, this graph you're looking at here is actually one of my favorite graphs. I call it the spaghetti chart. And it's taking someone's withdrawal pattern, their projected withdrawals that they need to maintain their lifestyle throughout retirement, And every yellow line represents an actual asset path as if they had retired in 1927 and taken that withdrawal pattern, and then 1928, and then 1929, and then 1930, and so on. So each yellow line is an actual historical asset path. And you see down here, there's some that didn't make it. And these were people who retired typically in the Great Depression. So that same withdrawal pattern, actually it's the same person. And there were times where we would have said, you know what, we're going to have to make some spending adjustments or the portfolio won't make it. Now in that case, these yellow lines all occurred in that Great Depression era. If you create this critical path and you know where your portfolio needs to be ahead of path, then as we go forward in time, we track one yellow line. So you will only get the luxury of one path, your asset path, and how does it track against where it needs to be for you to stay in the green zone. That is a different way of managing investment risk where the metric is now your goals. It's not some outside benchmark like the S&P 500, and it's not some arbitrary measurement of risk like standard deviation that actually has zero relationship to your long-term goals. It's now a path that's measured against what you need your money to do for you for the rest of your life. And that's the kind of managing investment risk that we want to see more of as people transition into retirement. It helps reduce stress, reduce anxiety, and it allows you to make dynamic changes along the way. If your portfolio ends up in the red zone, you can say, you know what, maybe we won't increase our withdrawals for inflation this year. Or maybe we'll take a vacation, but it's not going to be the one that costs twice as much. So it allows you to make small changes along the way that keep you moving up here toward the green zone. Now there's a big difference between managing this risk in this way and reading some of the academic models that are available, on the internet. I love all of the academic studies. I think they're fantastic. But these are quotes that have actually been taken out of various studies that I've read. Taxes are ignored. One impact variable that is not considered in this analysis is risk, not risk tolerance or risk preference. Many studies only use two asset classes, stocks and bonds. This study did not account for investment expenses, trading costs, or advisory fees. So when we see rules of thumb that come out, like the 4% rule or various studies on portfolio structures, a lot of times those studies are not accounting for all of what I call real world, the real life factors that we have to deal with real life retirees. You know what? I don't know about you, but I pay taxes. I don't have the luxury of ignoring them. And I pay investment expenses. Those are real. And I have a risk tolerance. Now, mine is pretty high because this is what I do for a living and I'm not concerned about volatility. But I have to talk to clients every day, and I can assure you when the markets go down, risk tolerance and preference are factors. The sleep at night factor is an important one. So in the real world, we don't have the luxury of ignoring these things, whereas many of the academic studies have to simplify their assumptions in order to run the study that they're trying to run. So just be cautious as you read some of the stuff that comes out. It's all good stuff, but you can't necessarily take it as written and apply it to your situation. And then the last thing on the side of the drawing of things we can control is your retirement date. Now, I say that there are often cases where people are forced out of work early, layoffs happen, but if you have a plan in place, it's a lot easier to adjust for those things. And the thing that I love about what we do is you can have two people come in with the exact same circumstances. And one might say, gosh, you know what? I want to retire early. And we run the projection and we say, you know what? If you want to retire at 55, after we factored in the health care coverage that you're going to have to pay out of pocket between here, and inflation and taxes, you can do it, but you'd have to adjust your lifestyle down to X. One couple or single will say, absolutely, if that's what it takes, I'll do it. And the next couple or single might look at the exact same financial circumstances and say, you know what? No, that's not a trade-off that's worth it to me. I'd rather continue to work and be able to maintain the lifestyle that I like and not have to make any adjustments. And there's no right or wrong. Seeing the numbers in the plan is what allows you to bring your values to the table to decide what's really important to you. And everybody has a different set of values that they bring to the planning process. When we look at the value of the planning work that we do, this is an analysis that Vanguard did in 2014. And there's different components, and they broke out and said certain components can add what these are called are basis points. So 0.45 of potential return means about 0.5% a year. Now, not all of these apply to everybody, but certainly some people have very high expense investments right now, and I've seen cases where clients were paying 3% a year or more in investments, and we were able to cut that down by over half. In that case, the potential return of reducing their investment expenses was far greater than 45 basis points. And then there's other people, behavioral coaching. For clients who are nervous and prone to making bad investment decisions, this is worth a lot. But there's other people who, they're great long-term investors. They don't worry about the markets, and in that case, this component isn't worth as much to them. But overall, everybody has certain components where the planning can definitely add value and put real money into someone's pocket. So in conclusion, what is the key to retirement success? The key is knowing which side of the drawing that you're on. And what we see overwhelmingly is people focus on this side, when in fact the key to retirement success lies on this side of the drawing. So if you want help planning out your own retirement, who do you turn to? Now, I know this is getting better, but right now there aren't a lot of standards about who can call themselves a financial planner. We are, in fact, what are called fee-only planners who have a fiduciary obligation, a legal obligation to give advice in our clients' best interests. And we sell no commission products. Unfortunately, right now, that's still the minority. About 94% of people who call themselves financial advisors, in fact, can be compensated in some way by commissions. Part of my mission is to help change that. I think fee-only advice is the way to get the most objective advice that you possibly can. Now we're going to open it up to questions here in a minute, and Kathy's going to ask you to type in questions. She's going to read them off. For any of you who do want to talk to us, if you send us an email to info@sensiblemoney.com and just email the subject line PMQ, we always offer complimentary introductory meetings where we talk more about our services. Prior to that, when we get the email, we send you an online set of questions to complete, and we send you a link to a page on our website that talks more about our pricing and our services. So you're welcome to do that, or just visit our website to learn more. And right now, I'm going to open it up to questions and answers. Kathy, are you there? Kathy? All right. Might be reading my own questions. So Kathy, if you can hear me, it says that you are self-muted, and we can't hear you. So while she's working on the sound options, I am starting to see some questions come in, and I'm going to ask you to just keep typing. We're going to go to at least probably 6:30, or if I get all the questions answered before then we'll stop it, early. But sometimes we get more questions than I can answer, and if you type one in and we don't get to it, then typically we're going to email you afterwards. So let me start. Let me scroll down. Trying to get to where the questions are coming in. So what is the most effective way to find a fee-only advisor? A lot of that depends. There's a website called NAPFA, NAPFA.org. You can go there and do an advisor search. That will find you a fee-only advisor if you want to work with someone local. If you're comfortable working long distance, then of course we would encourage you to inquire more about our services, but we understand not everybody's comfortable working via the internet and the web like we are tonight, and so you may want to sit down face-to-face, and I would highly then encourage you to visit NAPFA, NAPFA.org, and do an advisor search. Do you charge a fee for, let's see, you charge a fee for writing a plan and for the investments purchased? So the way we charge is when we do an introductory meeting, we estimate the number of hours that it would take to put together your plan. Typically, our minimum is 20 hours at $150 an hour, so about $3,000. We collect a $500 deposit, and through the planning process, if we end up taking over the investment portfolio, then we transition to a percentage of assets, and we quote that price as we're going through the planning process. Larger portfolios are a lower rate, smaller portfolios are a higher rate, and in that case, then we waive either all or the majority of the planning fees. Do you use asset dedication to help design portfolios? So yes, Asset Dedication is a firm out of California, and the graphs that we looked at with the critical path and the green and the red with the yellow squiggly lines, those are their slides. And we essentially do all the planning work to design the portfolio cash flows. We send those cash flows to them, and they come back with the proposed portfolio structure. And then if we want to implement them, that actual portfolio structure, then they're going in and placing trades on our behalf. So essentially we've hired them to build out that portfolio, to actually place the trades and buy the bonds per our specifications. Another question, what's the 4% rule? So great, that's a great question. It comes out of a study that was done, I believe, in the 80s, although I can't remember exactly. It was called the Trinity Study. And it was a study that said, you know, how long can your money last in retirement? And the conclusion was that if you followed, you know, in general, a portfolio that was about 60% stocks and 40% bonds, then you could withdraw about 4% of your portfolio value a year. And so if you had 100,000, you could withdraw about 4,000 a year. And that became known as the 4% rule that retirees should follow. What is a reasonable annual fee for good financial advice and planning? That is difficult to answer in dollar terms because it depends on what someone is doing for you and the amount of time it's taking them. So, you know, an average fee on financial planning, I mean, about the minimum I've seen is $100 an hour, and then people charge up to $300 an hour. It takes a lot longer than you might think. So our minimum to initially get the plan and everything we need is 20 hours, and oftentimes we end up eating a lot of hours because we've quoted someone a price and it can take far longer than what we've quoted. As far as the portfolio structure, an average fee is, you know, believe it or not, we see a lot of brokerage firms that charge 2% a year to manage a portfolio, and they provide absolutely no planning or tax management. We think that is just horrible. But the consumers don't know the difference. They think they're getting some kind of trading process or philosophy that's going to get them higher returns, and in reality, that's not the way it is. Typically, you should pay less than 2% a year for larger portfolios, less than 1% a year, and by larger, I mean talking about, you know, portfolio sizes over $1 million. Is there somewhere that would show me how to calculate my curve or path? There are no, you know, real online programs that I know of, although many of the online retirement calculators, if you plug all your expenses in and all your sources of income in, and then you plug your, you know, your assets in, I mean, it's a complex calculation that's showing you if you withdrew this dollar amount and your portfolio averaged this rate of return, how long would it last? So right now, I don't know of any way that you can actually do that online. And yes, so along with that question, to calculate your path, you take your total assets and curve it down to your life expectancy of 0. Sort of. When we calculate a critical path, it's not just your total assets, but it's all of the cash inflows and outflows that are occurring behind the scenes. So for example, let's say someone was retiring at 60, but they weren't going to start Social Security till 70. Their particular path may dip down, and then once Social Security started, may may go back up. And so it's not just as simple as taking a path and just projecting it out. It's taking all of the timeline of things that are going to be deposited into the accounts and withdrawals that are coming out, including taxes, and then using that to create that path. All right, so let me see if there are any other questions. Yes. Do you help with tax planning? Yes, we do. It is an extensive part of what we do in our planning process, which is why it takes far more time than simply plugging something into an online calculator. And I see another question. The majority of our retirement portfolio is in a company ESOP, and ESOP is an employee stock option plan. Can you talk about ESOP options? A little bit. Most employee stock option plans are going to have the option of something called net unrealized appreciation. So you may have the option of distributing stock from your plan under special tax rules. And it's, again, beyond the complexity of going into in this webinar, but when we come across those situations, it's a whole separate analysis that we do. And I'm assuming that's the kind of ESOP plan that you're talking about. Does your calculation include confidence bounds based upon actual statistical modeling? We do Monte Carlo, although, yes, we actually do this in several ways. So when we deliver our plans, they're delivered over a series of strategy meetings. Strategy 1 we call big picture, and we do a Monte Carlo analysis. There's a lot of industry proponents that will say that that's not as useful as we think it is. Monte Carlo will often run economic conditions that theoretically aren't even possible, but I think it's one part of a retirement test that we run. We also use some other modeling. The critical path that you saw was one of them, and then we use something called a fundedness test. So we like to run 3 different tests to see if someone's plan works. We have certain parameters or guidelines we want to see those results come in at for us to feel confident that the plan will work. So this is just a comment I'll pass along from one of the attendees. It says, regarding the online calculator, there is an iPad app called Retire Plan that allows a person to do a scenario planning with a variety of factors assumptions. I don't know if I've used that one. I've used many of them, so I'll just pass that along for the audience. Does living overseas, this is another question, I'm in Japan, make any significant changes to these planning scenarios? Well, that depends on where you're going to pay taxes and whether you'll be moving back. And so the answer is possibly yes. This question, what's your prediction for the stock market for 2016 and 2017? Well, I keep a crystal ball in our conference room, and when people ask that, I just turn and look at it. We don't make any predictions. It's not the way our process works. We want to know that regardless of what the market does, that somebody's plan is going to work. And so, my prediction is that over 2016 and 2017, the market's going to go up and the market's going to go down. Next question. What is the best way to look at tax efficiency of various income streams? Well, the best way is to project out each and every year what your gross income and then adjusted gross and taxable income is likely to be, and apply a tax rate to that. So you can see, for example, if you were to take money out of your IRA and that added $20,000 to your taxable income, you can actually see the tax effect of that. So the best way is to create a timeline where each, you have a column for every calendar year and you create a timeline of what that's going to look like. So this is a question. Dana, your presentations are great. Thank you. If I begin with the introductory conversation and get placed with one of the other planners in the group, how do I know that I will get the same service as if I was placed with you? Thanks. It's a great question. I do not work with new clients now, but I do join my planners on meetings and review plans with them. We all use the same process. They all trained with me. We use the same software, the same strategy process. As a matter of fact, that picture we showed at the beginning of the webinar was everybody here for a week in October of training, and we have a big training manual that we use. So yes, I can assure you that it is the exact same service and process, and that's really important to me because I want consistency in the way that we do these plans and how we test for success. For my person who asked about Japan, you will always pay taxes in the U.S. no matter where you live. Thank you for clarifying that. Please show screen things you can control. All right, let me see if I can get back to that. Here you go. So this drawing is also on our website. So if you click through our website, you will find this same drawing as well as several others. Another question, what do you think about consumption smoothing planning? Well, I'm also friends with Larry Kutlikoff, and he is essentially known as the proponent of consumption smoothing as his online software, ES Planner. I think it's great in concept. It's often not practical. So consumption smoothing, the idea is that we want to maintain a standard of living. And so yes, that is what we try to do with our planning also. But in reality, as we looked at, there are different phases that people go through. And there are certain phases in life where we spend more on discretionary items, and there's other phases where we don't. So it's not always practical for the way that human beings behave. How do you match a client with your employees? Typically, it's by location. So Kathy works with a lot of our East Coast clients. Brian, who's in California, works with a lot of our West Coast clients. And Chuck, who is here locally in Arizona, works with clients that come into the office. It doesn't always have to be by location. Kathy really enjoys working with single women. So if there's a specific situation and someone would prefer that, then that can always be requested. What was the name of the book about strategic use of debt? I think it's called The Value of Debt. And I'll tell you what, I can see who asked the question, and we'll be able to email you that. So I will look it up afterwards and email the specific name. All right, I'm going to go through a few more questions that are coming in. What broker?
I'm back. Sorry about that.
Oh, hey.
I don't know. I could not get unmuted, so apologize. But you went through the questions. That's great. So
I did. I'm still going through them. Let's see. Where am I at? I just lost my place. So there's a great site for figuring out how much you can spend. The spreadsheets you can download work very well. And I don't know what site that is. I know there's a lot of great sites out there that have budget worksheets. I see. Why do we work with asset dedication? We work with asset dedication because what they do is phenomenal, and it's a matter of efficiency. So they build our equity portfolios with using something called dimensional or DFA funds, and then they build the bond ladders, and they build all the critical paths. So essentially, if you think about a firm our size, I have 6 employees. I either hire a dedicated portfolio manager that's going to place the trades and do all of that, or I hire a firm like asset dedication. And so when I looked at that, I decided, well, if I hire a portfolio manager, they might get sick or quit or move across the country, and now I have to hire another one. And that was, I didn't want the quality of our service dependent on a single individual, which can happen as a small firm. And so it made a lot more sense to find a firm that we could outsource that function and really work closely with like a partner. And that's what allows us to build. We look at, we want to make a lifelong commitment to the client. And so that was part of that choice to work with asset dedication. So one of our attendees has passed along the website that helps you figure out spending. It's called How Much Can I Afford to Spend in Retirement.blogspot.com. That sounds like a great resource. When will your new book be out? I am targeting March 30th for a book that will be called Retirement Sense, and it should have all the great content that I can use from my first book called Control Your Retirement Destiny, and I've been working away on it. All right. What can a low-risk investor do? Save more. That's my number one answer. Annuities can also be a good option. You have to understand that low risk means you are not giving yourself the potential for higher returns, and there's nothing wrong with that at all. It just means that you will have to accumulate more capital to be absolutely assured of achieving a certain standard of living. Another question, lump sum versus annuity in retirement. How do you figure out which is better? Well, we use the analysis that we had looked at earlier to project out how long the money would last if you were to invest it and what rate of return you would have to earn. If that rate of return is too high and unrealistic given past market returns, then we would say you're probably better off taking the annuity option. Oh, thank you. The debt book is by Thomas Anderson. So yes, it is. And the person that just typed that in, if you can think of the name of it, I will pass that along. I wrote a book review on it, but the name is slipping my mind right now. And then that same person said, talk about my book. My book, I talked about Social Security since. I had a book out called Control Your Retirement Destiny and went through a lawsuit where it was court ordered off the market due to an Excel projection that was used in it. That's a long story. But the good news is I'm working on getting it back out there, and the target date is March 30th. Thank you. So the name of the book on debt is, I got it right, it was called The Value of Debt in Retirement. And it's by Thomas Anderson, The Value of Debt in Retirement by Thomas Anderson. So we're running a little bit over. I may not have gotten to all the questions. If not, we'll try to reply to you one by one. I want to thank everybody there's still a lot of people who stayed through all the questions and answers. So thank you, everybody, for taking your time to attend. Our next webinar is going to be Tuesday in February. I think it's the 23rd. And I'm going to do a new one called How to Invest for Retirement, where we're going to dig more into the particular investment strategies. We talked a lot about the planning factors tonight. So how to invest for retirement, Tuesday, I believe it's February 23rd, will really be about digging into different investment strategies that you can use. Thanks everybody for attending, and have a great night.